We are back with you on Voices today, and going into the commercial break just a second ago, I asked a scintillating question. Is there some conspiracy among the central banks that's going on to kind of keep all of us normal people, average Jacks, Joes, and Dans in the street, dumber to their benefit? We're actually talking about money and supply and demand of money, and how much money could be too much money. How could too much money be a problem? Isn't the more the better in this case? There's no such thing as the law of diminishing marginal returns when it comes to money in your pocketbook, is there? Richard Werner from ProfitFund.com rejoins us from Tokyo today. Did I just ask the right question there, Richard? How much money is too much? That's not a problem.
Exactly.
I love
so the
money.
question should be different. The question should be, do we have enough money? Especially me currently being in the Tokyo studio, where we come out of a sort of 10, 12-year recession, and the answer was no, there wasn't enough money going round. But basically, it's always the restricting factor, the limiting factor on growth is the quantity of new money injected. But actually, the other question you could ask, well, what is money? What are you talking about here? And for some of our viewers, what I've said, that the quantity of money is key and is easily able to beat interest rates as a forecasting tool. You know, if you're thinking of asset allocation and investments, you know, you can better your models by dropping interest rates. They drop out anyway in most models because they don't have explanatory power. Move to quantity of money variables. But which ones? Well, the monetarists, and many viewers may remember Milton Friedman, who passed away only November last year, did great work on the monetarist approach, and he was also saying the quantity of money is key. But from the 80s, the monetarist models started to break down, and there's a reason for that. Basically, they focused on the wrong measure of money. They focused on the M1, M2, M3, M4, M5, M25 around London type of indicators. These are all measures of deposits. They're all savings indicators. That's not even the money supply, that's savings. What is actually money? We won't have time to go into detail. I'll give you the key word. It is the purchasing power that's newly created by the central banks and the banking system. You can measure it through credit creation, which is something the Profit Research Center in Tokyo measures for almost 40 countries. And that gives you the best indicator of, well, if you have more really active money in circulation, you get more transactions, you get more growth, good for equities, you get less growth, good for bonds, and the relative credit creation is your currency indicator, and that's how you can actually not only explain but also forecast the key macro asset classes. And that also explains central bank policies, unlike interest rates. So the ECB, for example, there's one interest rate for the whole euro area, but in 2002 the ECB told the Bundesbank to reduce its credit creation by the biggest amount in its history, and told the Irish central bank to print as much money as if there's no tomorrow. What do you expect is going to happen? Same interest rate. Is same growth? No. Recession in Germany, boom in Ireland. Which one tells you that? Which variable? Credit creation. There you go.
So in other words, just to use a real-life example, instead of listening to Bernanke talk all the time, and I'm guilty of that, I shove him, every time I see something Bernanke, I go, ooh, let's hear from Dr. B. What we missed was the automation and the software adoption in the subprime lending, mortgage lending industry in the United States, which led to the current meltdown that's going on there. I mean, in other words, I could go online and I'd be approved without talking to a single human being, and that was credit creation. That was easy money, and now we see what's happening. Correct?
That's a good example. That's a good example. So if you'd followed credit creation, its quantity, and has to be measured correctly, and there's some issues there, and we've solved those at the Profit Research Center. But if you do that, you wouldn't be surprised by what's happening in the US or Europe or Japan or any other place. So yeah, it's the quantity and also what the money's used for and how much is created.
What would you hold as a prime example, an A-plus example of responsible credit creation and formation and balance? It wouldn't be the U.S. Japan, if anything, errs on the extreme side of caution, correct? China is trying to cool things down with little bits and pieces here and there. Reserve ratio hike, a little small interest rate hike, a wee little teeny weensy bit of interest rate hike. Who's got it right? What's a good model to go by?
It was actually the Bundesbank before it was abolished in 1999. and it's now just in existence by name. It's really the ECB that's deciding the quantity of credit policies. There was never a bubble in post-war German history under the Bundesbank. There was never a significant recession based on a credit crunch. It was a fairly stable policy. Still not ideal, of course. There's always room for improvement, but I think it was one of the best in the world, and it seems that's why the Bundesbank had to go. It's gone, and that's why we have to expect, well, since then we've had much bigger cycles in Germany. Immediately the ECB sent Germany into massive recession. Now it's a recovery. The cycles have started. Welcome to the rest of the world.
At the very least, Richard, we're raising questions today, and for the people who are tuned in out there in TV land today, okay, at least we've probably raised more questions than given answers in many ways. Yeah, well, a lot of people had assumptions which they've always lived and died by, and all of a sudden, here we are talking about things which seem sacrosanct, or basically blasphemous, or completely flies in the face of common wisdom. What do people do with this? What are they supposed to take away from this conversation we're having, and actually look at what they have or don't have, and how can they improve their lives?
Yeah, well, there's many applications. First of all, you can save a lot of time by giving up listening to central banks when they talk about interest rates. I mean, that's always going to be old hat, an old story about a variable that follows growth. It's so behind the curve, it doesn't give you any lead, indication. So forget about that. And also, the speeches by central banks, I mean, yeah, they could, if they're surprising, they could have a temporary effect, but really what matters is the quantity of credit creation. Anyone interested in that and its application, we won't have time now, but you could look up my book called New Paradigm in Macroeconomics, published in the UK by Macmillan, Keynes's publisher. A New Paradigm in Macroeconomics, if I may say it again. But the investors would basically have an immediate application as well. When credit creation, in the broad sense, there's broad measures, expands, there's going to be more growth. This means there will be basically aggregate operating profits rising, and that means equity markets will go up. And when there's credit reduction, a broad credit reduction, then it's bad for equities because profits are going to go down or slow down, rather. And that's better for bond markets. And what about currencies? Well, I mean, there's plenty of good stories, examples of what's been happening there. It's the relative credit creation on a narrow measure that gives you the best currency model. For example, last year, 2006, May was a dramatic month, I think, by any standard, in equity markets, but also in currency markets. Now, in February, March that year, my company, Profit Research Center, we switched our rating on the Turkish lira from buy that we previously had for the previous year and did very well. The lira went up, to sell. At a time when nobody was talking about a sell, investors told us, well, look, if you sell it, the carry is so expensive. I mean, this is crazy. What are you talking about? No rumor. Why do you say this? Well, our credit creation model told us the lira was going to collapse. And, we tend to be a bit early, but, that's an advantage. So 2.5 months later, the lira collapsed quite significantly. They were printing money like crazy. But you have to measure it correctly. So the standard measures, like high-powered money, don't tell you that. Because look at Japan, the best example. What's high-powered money? It's cash in circulation, which is a drop in the ocean, and banks' reserves with the central bank, which were huge. But that's not money in circulation. That's money out of circulation. The bank's putting more money in the central bank. How's that going to help or affect anything? So you have to measure correctly, and we're doing that. But then, you can actually make asset allocation decisions on that. You have to assume that people are rational, though, right? When you make your... That's fine, when you do your analysis. I mean, you have to assume they know when to stop forming credit. Because, going back to the subprime example, that's what happens when you get a little bit too foot loose and a little bit too free and easy. Well, that's where the central banks come in. That's the responsibility and the actual job of central banks because each individual bank, we've seen in every bubble, whether it's the US or Japan in the 80s or the UK now or whatever, individual banks, they cannot see beyond the end of the plate in front of them. They try to maximize their own little profits there, but the aggregate result for an economy may be extraordinary, that the whole banking system is creating far too much money. That's the job of the central bank. They know this. They see this real time, online every day, and they know very well what's happening, and they have ways and means, that's another story, to either accelerate or decrease credit creation. I've shown in detail that central banks have always used informal guidance of the quantity of credit created by the banking system as one of their key policy tools. And that's in my other book, Princes of the Yen, in particular on the Japanese case or Asian case. Well, there's other ways to do this, but basically it's the central banks where the buck stops, and they have the responsibility and the ability to therefore create the cycles. And that's actually where we come full circle, because you talked initially about the legal structure of central banks. Now here we have this institution that runs an economy, but is totally unaccountable, and that means mistakes can be made, and they are being made.
Richard, very interesting talk in a lot of ways.
Thanks very much.
I'm going to listen less to Bernanke and Fukui, and I'm going to look more at credit formation, or I don't know, maybe call you next time. Hey, thanks for being with us today, okay?
Thanks very much. I appreciate it. Cheers.
Okay, Richard Werner, ProfitFund.com on Voices Today. Thanks for watching. Hope you learned something about how central banks operate and their mentality.